Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is off this week, so let's get to the biggest stories right now in the more than $16 trillion global ETF industry. And we start with stocks under pressure, with investors on edge about the potential for more tariffs from the Trump administration. And in just moments, we'll speak with GlobalX CEO Ryan O'Connor on the firm's newly launched credit ETF. And then sticking with corporate bonds, Vanguard planning its first ever junk bond ETF. The firm really jumping into a competitive corner of the space as that active race heats up. All of that and more. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, thank you. So last week I mentioned that, the flows were a little weak, but the bullishness will be back, and it is. IVV at $9 billion, that's a lot of money. You know, BlackRock put out a report saying it did like U.S. equities. That could be some of BlackRock's model money rotating into IVV. SPLG is also an S&P 500 ETF. It's the sort of mini-me, cheaper version of SPY, $2.36 billion. And then you got VU on there. VU always on there. And so a lot of S&P 500. And then VTI is the total market U.S. equity. And then down here you have equal weighted S&P 500, and then the Qs. So it's basically a clean sweep of U.S. equities, except IMG, which is interesting. Emerging markets, like small caps, just can't really ever get going. We'll see if this starts it. This is the biggest flow in June we saw into emerging markets, biggest month in years. So we'll see if that's a false positive or the real thing. We'll stay tuned on that. Let's look at the outflows. And you'll see here there is some outflows out of Q, so not perfectly bullish, but some money coming out of there. Some of this stuff here, this is the Russell growth value. There was a rebalance, so this is tax related. I won't go into it. TLT is legit, though. And remember, we had Rick Reeder on last week. You know, this is a tough trade. TLT, the widowmaker, making more widows here as people did not get the bounce they were hoping for there. Let's look at something we haven't looked at in a while. Since we have GlobalX on, I thought we should look at thematic investing here. What's going on there? Theme ETFs this year have only taken in $2 billion, so they're not crushing it. But inside the thematic world, there's always a lot of stories. The biggest story, in my opinion, is defense ETFs. Look at the flows into the defense theme, really since historically, right? That nothing really going on, and then boom. Really, got really triggered by the potential of NATO and the U.S. isolationism, yada, yada. Europe started to spend more money on defense. So Europe really driving this, although Korea defense is up too. But again, Katie, every theme needs its day, and defense is finally having its day.
Finally having its day. Eric, thank you. Joining our conversation now, I'm pleased to say we have Ryan O'Connor. He is the CEO of GlobalX, which has around $60 billion in assets under management. Great to see you in person, Ryan.
Great to be here, Katie. Thank you.
Let's talk about GlobalX overall, because you joined us in April 2024. I believe you were days on the job, and you were brought really to turn things around. We had a lot of product closures. We had a lot of leadership transitions underway. More than a year later, what is still left to do?
Well, look, first of all, thanks for having me back. Love being here. We've had a great time over the last year and a half. Over $10 billion in assets under management that we have raised on a net new basis. We just in the U.S. 2 weeks ago crossed the $60 billion AUM mark. We've launched a number of new and interesting and innovative products, which we can certainly talk more about. And like I said, we've had some fun. So it's been a good run.
Let's talk about Shield. You have a defense ETF. Of course you do, right?
We do.
You have every theme pretty much. What's going on here? What's all the interest? Is this a theme really driven by Europe, or is there more to the story?
Yeah, so for us, it is a global defense technology ETF. And, look, from our perspective, we launched this fund less than 2 years ago, Eric. In that time period, as you all know, lots of ETFs have launched, 1,300, a little bit above 1,300. Only 2% have raised over $2 billion. Ours is just under $3 billion. So it's a theme that really has been exciting for us and our clients. We continue to have client feedback around the need to invest more in defense and defense technology, and that's something we continue to be excited about into the future.
Katie, Shield up 58% this year.
That's pretty good. I mean, it really speaks to how theme ETFs, it's like you can really have these big pop moments or you can fizzle. So let's talk about the fizzling, because I have to imagine from the issuer's perspective, it must be difficult to decide which theme to really put a product behind, throw your weight behind, and invest in, for lack of a better word. So talk us through that decision tree.
So the three words that we think about are, first of all, is it possible? Is it possible in a 1940 Act structure? That's the first and most important component. Second, is valuable. Is it valuable for clients? And then third, is GlobalX credible in launching and running that type of ETF? We spend a lot of time listening to our clients as we think about those three words. And ultimately, we have a deep amount of conviction in all of those themes that we bring to market. SHLD and global defense technology is a very good example of that.
And I know that Bloomberg Intelligence keeps a Lazarus list of, ETFs that shut prematurely and might have missed their moment. I want to bring that question to you.
Sure.
I mean, when do you decide that this thematic ETF that you launched maybe just isn't worth it and risk ending up on that Lazarus list?
So look, we spend a lot of time looking at and thinking about our launch process and the different funds that we have out there. The last time I was on, we talked about the 1, 3, and 5 year kind of reviews that we do. At the same time, there are a number of themes that we have that are out there that have been around for a long time and take some time to really pop, Eric, to use your terminology. So from GlobalX's perspective, we are a thematic shop. That's where we come from. That's who we are. We're going to continue to stay, focused on that. But honestly, we're more than just thematics, right? Last year, we had the Emerging Markets ETF of the Year in ARGT, as you well know, Eric. Our CLIP ETF, which is our 1 to 3 month Treasury ETF, is now a $1.5 billion ETF. So exciting times across the thematic space.
Okay, one more theme question, I promise. Okay, you have AIQ.
Yes.
This is the AI robotics ETF. That's been a huge category. But you got these humanoid ETFs coming out now. You've got HUMN and COID, which are both out. Is that a theme that's actually ready? We debated this on our team because can you have a pure play humanoid, or is there a lot of what we call beta filler in those? And are you planning to, how are you going to deal with the onslaught of humanoids?
Yeah, so great question.
That came out weird, but you know what I mean.
So the first thing I would say about AIQ is, as we track that competitive universe, we have just less than 50% market share in that category with about $4 billion in that product. So that's one that we're super excited about. But look, on the humanoid side and the hardware side of robotics and technology, that's something that we see exposure to through bots, BOTZ, one of our larger ETFs on the thematic side as well. So the point is, you get exposure through bots, and it's a space that we continue to keep an eye on.
So you mentioned that you're more than just thematics.
Correct.
You recently launched a bond ETF, which is not necessarily in that universe. The investment grade corporate bond ETF, the ticker there is GXIG. So I know that you use AI in some sense when it comes to security selection here. You build this ETF as aiming to solve for the inefficiencies in fixed income markets. That can mean a lot of different things. Tell us what it means in the case of this specific ETF.
Look, the first thing I'll say is GlobalX is known for developing innovative and disruptive solutions, and we see this as being no different. When you look at this product, GXIG, it is an actively managed product which allows our PMs to take advantage of a quantitative factor-based model alongside artificial intelligence that really allows them to process a massive amount of information in the investment grade space in the US. Here alone, there are over 8,000 different bond issues in the IG US index from 1,000 different issuers. Our view is that there's no better place to apply AI into the investment process to potentially drive better risk-adjusted returns for our clients. And you know what the best part about it is? It's in an ETF wrapper, as you well know. Tax efficient, transparent, and reasonably priced. We've priced this product. It's the lowest in its category. It's also comparable to similar passive products as well.
Talk to us a little bit more about what role AI plays in the selection process.
Sure.
Like you said, there's over 8,000 bond issues, and there's a lot of ETFs, actively managed bond ETFs, that would say, we find the ones that are actually trading rather, and sort through some of the dusty old issues there. Why do you need AI to do that?
Ultimately, the one thing that I want to be very clear about is this is run by portfolio management. This is a human discretion portfolio. What AI does is allows our PMs to look through that raft of information to sort and understand where we want to be invested. So we think it's a matter of taking human intelligence and PMs on an active basis, combining it with that AI capability in order to drive better investor outcomes.
And I know GlobalX was first launched as for expats, and you had a lot of international ETFs. The Greek ETF, believe it or not, Katie, is up 56%. It's your second best performer. Not a lot of bites. What are these single country ETFs? How do you get them going?
So like anything else, we want to provide a full menu of strategies for our customers to choose from based off of what's going on out there in the markets. There can be, and there are many different catalysts in the market that drive that. With GREK, certainly we're waiting for that catalyst, and we've seen some catalysts actually ongoing, as you highlight. But from our perspective, as clients want to put on a view, Global X should have an offering out there for them.
All right, there you go. It is funny that flows don't always follow performance, is what we found out. And that seems to be the case when it comes to Greek equities right now. Ryan, it's great to see you. That is Ryan O'Connor. He is the CEO of Global X. Now, coming up, Vanguard is planning its junk bond debut, and it will carry a very Vanguardian fee. We'll give you the details next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Bitcoin. July is officially upon us, and that means that IBIT closed out another month of net inflows. Since it came into existence in January 2024, it's only posted one single month of net outflows. What does that mean for BlackRock? It makes more money in fee revenue yearly from IBIT than it does from its S&P 500 fund IVV. Certainly a sign of the times. Let's move on and let's talk about listings, though. This is something that I like to keep an eye on because we know that NYSE absolutely dominates when it comes to overall listings, about 55% of all products. But if you break it down by year, you can see that their lead is narrowing. Take a look at the right side of that chart. In 2025, you can see that NYSE still is commanding the lead there, but SIBO, NASDAQ catching up. We'll see if we get the flippening. And let's end on Vanguard, because I have Eric Balchunas sitting next to me. He literally wrote the book on Vanguard called The Bogle Effect. Vanguard, it filed for its debut junk bond ETF last week, which definitely turned some heads. But Eric, as you know well, they are very familiar with junk bonds when it comes to the mutual fund format.
Yeah, so they have a mutual fund. It's the second biggest at like 24 billion, and it's doing well. It's beating the S&P 500. I mean the HYG, which we the benchmark at it by about 7% over 10 years. So there's a lot of outperformance in the high yield space. I remember for years, people always wanted Vanguard to launch a gold fund and a gold ETF and a high yield ETF.
Yeah.
So it's been a long time in the making, still no gold, but the high yield is here. I think they wanted a passive, but it doesn't matter. The category for high yield has been Vanguarded already, even without them. You can get the junk bond ETF that's cheap and deep for under 10 basis points now. There's multiple choices from Schwab and BlackRock. So even
those are passive, though.
Those are passive.
Yeah.
So this is active at 22 bips. And I think it's part of their real push to increase their active flows, which is the only area that they're losing market share. If you look at Vanguard across the board, it's their active where they've got JP Morgan, DFA nipping at their heels, and I think they're looking to change that.
Yeah, big time. Let's talk a little bit about JP Morgan, though, because this caught my eye because it's Vanguard's debut junk bond ETF, but also because, remember, JP Morgan Asset Management, it just launched its first actively managed high yield ETF with a $2 billion anchor investment, which we talked about on this show. So it seems like Vanguard, as you just laid out, has some very stiff competition.
Yeah. Now, if you ask them, they'll deny that that affected them at all. You know how PR people are. But I think it did. Because we look at the flows. If you look at the flows, JP Morgan has taken in 4 times more than any other active manager over the past year. They are running circles around the industry. And if you look, they're now the 4th in active assets. Guess who's 3rd? Vanguard. And guess who's coming down? JP Morgan's going up. So I do think it affected them also to open with $2 billion.
Yeah.
And they're the hottest bond manager. They have JPST, which is the biggest bond ETF. This is the 800-pound gorilla now. JP Morgan is the 800-pound gorilla of active ETFs. So Vanguard coming in is an interesting matchup. $2 billion is a great head start, though. That is a massive amount to start with. But Vanguard, $2 billion, they'll do that. They do that in their sleep overall. But I find this to be one of the more interesting categories.
Yeah.
We've got so many shiny objects going on, but this is a classic old school like cage match between two juggernaut managers in the junk bond ETF category.
Yeah, I'm excited, of course. The JP Morgan fund did launch. This is just a filing from Vanguard, so we have to wait, a couple months here to see that launch. Also, Capital Group launched an active high yield ETF in the past couple weeks as well. So a lot of issuers flocking to the active junk bond ETF space. We'll see who wins out, but still ahead, we're going to drill down into a new fund anchored by an investment from legendary value investor Bill Miller and run by a TCW veteran. And also a reminder that you can listen to Eric and Joel Weber on Trillions. It's their podcast that covers the industry. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time for today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at RW. First, rare two-letter ticker, by the way. I like that. Rainwater Equity ETF. So this is a classic actively managed ETF. A couple interesting things. First of all, Bill Miller is an anchor investor in this. Famous Bill Miller active investor who has invested in this fund. He's not managing it. You can see it's active. The fee is 1.25. It's a hefty, but we'll see if the performance is good. People might not care. It just came out, $12 million. It basically looks for quality growth. That's how I read, quality growth companies. But what's interesting about this fund, and let's look at the holdings and I'll show you, is it only has 27 stocks. So this is what we call concentrated, sort of like ARK in a way. If you go after just 27 names, you're definitely going to have a lot of tracking difference in the benchmark. But you can literally charge a little more because you're used maybe as a smaller portion of the portfolio. So there's 27 holdings. Here are the top holdings: Constellation, General Electric. You can see down there. Heavy software is one industry. It looks to be overweight. Now, it's so new. What's the point of looking at returns? So I thought we'd look at TLTS Go, which is this factor distribution function that we like to look at a lot to find out, okay, 27 names, what are you actually getting in terms of factors? So if we can show TLTS here, you can see that it is going to be really more into small caps than, this is the size factor, than the S&P. It's going to have more momentum in it than the S&P, and then it's going to have a lot less value. So we're looking at small and momentum are going to be two of the factors here that you're buying with this, Katie. But in the end, it's all going to come down to performance, I think, for this one.
Eric, thank you. And we will speak to the portfolio manager in just a minute. But we do have some breaking news when it comes to trade. President Trump posting on Truth Social that he has sent a trade letter to Japan to impose 25% tariffs on goods from Japan. Also, when it comes to South Korea, the U.S. to set a 25% tariff rate on South Korean goods. That 25% tariff on South Korean goods effective August 1st. Let's discuss now with Bloomberg's Kailey Leinz. She is the co-host of Balance of Power, joining us now. So, Kailey, we had been anticipating that we might get some letters. Give us the details of what we know so far.
Yeah, President Trump, Katie, had previewed this. He said as many as 12 letters could be sent today, basically informing our trading partners of the new tariff rates they would face on August 1st if no trade deal is struck. The first two he has led with, as you mentioned, are Japan and South Korea, each of them facing a 25% tariff effective just a few weeks from now. Now, the president did say that they could consider a readjustment, his administration, that is, to the tariff rate set out in these letters if indeed these markets were open to the U.S. and tariff and non-tariff barriers were eliminated. So leaving a bit of a window here for some negotiation or wiggle room, potential changes that could happen over the coming weeks before August 1st. But he also issued a warning to these countries not to raise their own tariff rates in response to the 25% rate now put on their goods, whether from Japan or South Korea, respectively. The president warning in this letter, if for any reason these countries decide to raise their tariffs, whatever the number you choose to raise them by, I'm quoting directly here, will be added onto the 25% that we charge. So he clearly doesn't want to see any kind of retaliation from either Japan or South Korea, which again, Katie, are now facing a 25% tariff on all of their exports into the United States effective on August 1st. And we do expect that more of these letters could be coming over the course of today as we get closer to what was originally a July 9th deadline, though August 1st is now the date we're all focused on.
Absolutely. That is Bloomberg's Kailey Leinz. You can catch her on Balance of Power at 1 p.m. for more reaction. You take a look at the reaction in the equity market really quickly, though. I will note that the S&P 500 hit session lows after we got these headlines in terms of tariff rates on Japan and South Korea. And as Kailey said, we can expect more of these headlines throughout the coming days. So we'll keep a close eye on that. But let's go back to that Rainwater equity ETF, because I'm really excited to speak to the man who runs it. His name is Joseph Shaposhnik. He is the founder of Rainwater Equity and formerly of TCW. So as Eric walked through, this is sort of an old school stock picking ETF, a concentrated portfolio of high conviction names. And Joseph, as I understand it, you're going after recurring revenue businesses.
That's right. The portfolio is dedicated to investing exclusively in recurring revenue businesses, and that happens to be waste collection businesses, software, stock exchanges, all types of businesses that are recurring, aftermarket aerospace parts, the kinds of products that companies will be able to see revenue come in on a very regular basis without them having to guess as to when revenue will be coming in. We think that advantages them significantly, and not just domestic businesses, but as you mentioned in the lead up, small caps, international companies, everywhere we can find high quality recurring revenue businesses that generate cash flow, we're on the hunt for them.
And let's talk about what I mentioned earlier, the concentration of it. You said the mutual fund industry is broken, and a big reason is so much closet indexing going on. You clearly aren't doing that here. Can you talk about why you decided to be, 27 stocks, very concentrated, and what that does?
Yeah, I do believe the mutual fund industry is broken. If you look at the industry, 93% of mutual fund managers underperform on nearly any time frame, 1 year, 3 year, 5 year, 10-year bases. And the reason for that, I believe, is because most mutual fund managers look at their index and they try to come to a conclusion on each individual stock in that index. We think that that just doesn't work, and that you can't have an opinion on every business in your index. So instead of doing that, what we did at the old fund and we're doing in this fund is we're focused only on those businesses we think we can predict, which are recurring revenue-oriented companies. Now, in order to be able to outperform, as we did in the prior fund, we have to stay focused on those businesses that we have highest conviction in, and that happens to be around that 20 number of stocks. And so, historically, we've been able to generate better risk-adjusted returns with a more concentrated portfolio than a portfolio that owns hundreds and hundreds of stocks the way most other funds do.
Joseph, unfortunately, we have to leave it there. Have to have you back on soon. Really appreciate your patience with the breaking news. That is Joseph Shaposhnik of Rainwater Equity. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the TV show. I'm Katie with Eric Balchunas. This is Bloomberg.